Hello and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Metal, and I'm here today with Michaela Speer, wealth advisor with Physician Thrive Financial Planning. Today's podcast is going to focus on the early stage professional who's highly educated, highly indebted, and has yet to accumulate significant assets and feeling a bit behind from some of their peers in their savings and financial planning due to their focus on education. We're starting at square one today, and I'm stoked to have Michaela to help guide us on our financial freedom journey. So Michaela, with that, welcome to the show. Thank you so much for joining us.
Yeah, thanks for having me on. I think this will be a lot of fun.
Ditto. I'm really looking forward to it. And let's just start with a little bit of background. Tell us how you got into the financial service field and what your typical client looks like today.
Yeah, so maybe a little bit boring, but I did go to school to study finance. So the financial advisor route was definitely the one for me. I was interested in mostly personal finance and real estate. And so because of where we relocated to, personal finance was just a little bit easier to get into, then transitioned into a background with an insurance company before my husband started medical school, and then transitioned to work full-time as a wealth advisor for physicians across the country at a company that's here local to us. And our typical client is a soon to graduate or newly graduated resident or fellow from their training program. We get a lot of people for contract review negotiation, budgeting and financial planning, as well as disability and life insurance as they kickstart their careers.
I love it. What I love about you, Michaela, is you're living it, right? You're not only advising clients who are in that particular situation, but you're living that experience with your husband. And I think that makes you really, really valuable and have a unique perspective to our audience.
Yeah, it's been a lot going on in the last couple of days for anybody that is in the know of the residency or medical student world, but the match just happened. So we're currently getting ready to relocate ourselves to participate as part of this transition, which is going to be a lot of fun. So I'm starting to educate my own Instagram followers around everything that they can be doing or thinking about as this transition takes place.
Well, I'm excited for you and your journey ahead. Congratulations for that. And again, we're excited to have you share with our listeners today. And I think where we should kick off is let's talk about what you see as the number one reason why young professionals or those that you advise seem to fail with their personal finances, or what's the number one stumbling block you see them coming into?
I would typically say that the number one issue that our young professionals fall into is the lack of knowledge, which typically comes from the lack of time to find the correct resources to utilize. Just because they're spending all of their time, money, and effort working toward their professional careers, that they don't have the ability to do as much studying or research on pursuing things for their personal lives, and or then taking the steps to implement any of those strategies that can actually make real changes happen in their personal financial situations.
It can be overwhelming, can't it? I mean, I know I've had many conversations with young professionals, and it takes so much energy just to keep on track with their profession, to potentially, be a good husband or a good wife and a good parent, and to at the same time try to wrap your arms around what's going on with student loans and different investments. And should we put all our money in Bitcoin? I mean, it can be overwhelming.
Yeah, very overwhelming. The dishes, the laundry, and, for a lot of these people, it's just them. And then you throw into that equation the dating scene, where you're a young professional that maybe wants to have a family, maybe doesn't, wants to travel the world, maybe get a girlfriend or boyfriend, then start a professional career and buy a house. There's so much going on in your 20s and 30s, which makes this the perfect topic for us.
Yeah, amen. And I'm sure we're going to get into this, but the long-term impact of getting started young has such a profound impact of where somebody ends up 30, 40 years down the road.
Mm-hmm.
It is important, even though it can be overwhelming, to pick a path and to start making progress. So with that, let's kick off with the next question that I had for you is, where do you recommend highly educated, and of course we mentioned potentially highly indebted clients start for building financial awareness?
Typically, it is the liquidity side of things. So we want to first establish some sort of an emergency fund in the event that there is a major life event that takes place and you need to access a lot of cash. You don't want to find yourself putting a bunch of money on your credit cards, because then the low income, no income, and high debt continues to grow, and it becomes a lot more difficult to get out of that scene moving forward. But then after you've established that emergency fund, it essentially just builds the foundation for having the ability to start to invest and do some of those more exciting things that everybody talks about doing to actually build wealth, but nobody wants to talk about the boring things like money in your bank account, even though that is really where things need to start.
Well, having going through COVID, I own a medical office building, and I never thought the day I'd pull into that medical office building and there would be 0 patients and 0 doctors work at that facility. But we all got a very rude awakening of how fragile things can be and how important it is to make sure we have some liquidity. How did that, by the way, change your advice and strategy with clients?
COVID really put the emergency fund on the front runner,
right,
in our world, just because it really shows people anybody can lose a job.
Yes.
I think especially with our clients being young professionals, highly educated, you anticipate that job security is going to be there all the time. But we had a lot of physicians lose jobs or go part-time and basically be forced to take a huge reduction in pay because of everything. So even though you thought that, emergency fund's going to build over the next couple of months or whatever it might look like for you, that actually wasn't the case for a lot of people. They needed to dig into those funds or rely on taking out more debt,
which we want to avoid.
Yeah, absolutely.
So we talk a little bit about this idea of savings prioritization, but I know a lot of young professionals, when they get out of school, the gorilla on their back is this student loan indebtedness. So how do you help young professionals grapple with which to do first, or should they do it simultaneously? Save or invest, buy a home or invest? How do you advise clients through that thinking?
So we like to do everything from a goals-based approach, meaning what is your priority in terms of what's going to happen over the next 3 to 5 years or the next 5 to 10 years and then 10 years to retirement. Because very simply put, if you were going to buy a car in a year and you wanted to buy that car in cash, you would know that you have to put this amount of money away in order to achieve this goal. And so if we can apply that same mentality to any of the goals that we have throughout the financial planning years, it will be easy to achieve all of those things simultaneously, or at least prioritize what we want to happen in what time frame. But the debt investing trade-off is a huge conversation that I think a lot of young professionals are struggling with, because there's so much debt and there is huge interest rates on a lot of those professional loans for graduate school. And so depending on what you expect that debt repayment to look like with public service loan forgiveness or refinancing or time frame, it can help us make a much easier decision on what we should be doing with it. But more often than not, it won't be one or the other. It will be some combination of the two. And the easy answer is based on the interest rates. If you can find a very low interest rate to refinance your student loans to, and you are going to be able to see essentially a delta or a difference between investing in the interest that you're paying on those student loans, then we do want to pay less on the student loans along the way and invest that difference so we can see growth over those years.
Yep, I'm totally tracking with you. And what's coming up for me is, the question that I see young professionals grappling with all the time is, should we take the ultra low interest rate with a shorter amortization, and should we tie ourselves to a higher payment? Or should we take a little bit of a longer amortization, which then enables us to maybe have a little bit more liquidity, start down the path of investment, making sure we're hitting retirement funds, saving a little capital for down payment on a home? So which one of those strategies and why do you typically recommend?
Yeah, so I typically advise the longer amortization with the lower payment because it provides more flexibility from a cash flow standpoint. And a lot of financial books or podcasts or what have you will tell you that cash flow is king. And so I always like to throw in cash flow is king or queen. And so in this world, we need to have some free cash flow to fund those other goals. So it's either get out of debt or fund get out of debt and a new home and a new car and a retirement savings and travel or whatever else it might look like. Because up to this point, you've been accumulating debt and spending all of your time in school. Yep. And so we get a lot of people too that want to finally start to live their lives now that they have the freedom to do so. But if you're putting all of your money into that debt, again, it's not going to be there for you to do all of the things that you want. But when you start adding in those layers of accumulation, you're actually going to build wealth faster than just paying down the debt. So if we can do a little bit of both, we will see the overall financial portfolio grow much quicker than just reducing the debt in the shortest amount of time frame.
Yeah, I know one of the things that I have discovered in myself as a financial kind of thinking flaw is that I have to be all or nothing. I have to be all in on this investment idea or I shouldn't do it at all. And yep. In most instances, I, in retrospect, realized that was a mistake. I could have went in a third or a half, and I could have kept, the rest of my working capital for another opportunity and don't have to be all the way in. And I think that's the same thing when we talk about paying off loans or making a decision to buy a house or, starting the retirement investing. You can do those things all simultaneously, just maybe in little smaller chunks than you had thought of. The other thing that was coming up for me was, if we look at the historical returns of the S&P 500, it's north of 8% going back over 80 years. Mm-hmm. Very few people's student loans have interest rates north of 8%.
Yep.
So it almost always makes sense to, let's make some ground there. Let's chip down on those. But if we can grow wealth at 8%, look at real estate appreciation in the United States last year on an average, some areas were hotter than this, but 7.76% real estate appreciation across the country. Most people's student loans aren't greater than 7.76%. No. So especially in this age of, I'll call it asset inflation, assets classes, pretty much every asset class is doing very, very well. It pays to have some chips on the table in some of these different areas.
Yeah. And I think a lot of people understand in the investing world, diversification. People understand that is something that needs to take place within their investment portfolio, but they don't apply that concept to their full financial plan.
Yeah, great.
So do you really want all of your money going directly toward debt? Or if we put it into the investment world, bonds? You're guaranteed this minimum return in this one category, but you're not guaranteeing yourself any greater returns in X, Y, or Z. And so adding real estate or adding investment assets, or even just adding a car, which is not necessarily an intelligent, if you will, financial purchase, is still diversifying where your funds are going, which helps in the long run.
Yeah, I think that's a really good point. The diversification doesn't just have to be asset classes. It can be your global decision-making and thinking for a financial plan. That's interesting. Yep. And, we haven't talked, something I wanted to make sure we cover, especially for young professionals, about the time buying a house, especially about the time having children. How do you advise, and where does things like life insurance and disability insurance fit into this equation when you're trying to prioritize all these things?
So I would consider the risk management side of things a huge chunk of the pie in that diversification of where income should go. And it shouldn't necessarily take up a large portion of it, but it should play a role in the decision-making process. Because if you are a young professional and you're not married, but you don't have any kids, life insurance might not necessarily be something that you're considering at this point, because nobody's relying on you. You don't have any assets that, have to be repaid. But disability insurance is the one way to guarantee that that income you have worked so long and so hard for will still be there for you in the event of an illness or an injury. And that is well worth the minimal investment up front as you start your career. And then, as I think we talked about maybe once before this, it is not necessarily a long-term investment. It can be something that we consider having for the next maybe 10 to 15 years, as opposed to from now until retirement age of 65. Because as your wealth accumulates, the need for keeping that disability insurance around becomes a lot less important. You can self-insure in the event of a disability and stop transferring your risk onto the insurance company for that protection. And then in the life insurance space, once there are dependents, family members, kids, spouses that are relying on you for income replacement or future saving strategies, then it does make sense to start the conversation or consideration for the life insurance side of things. And at minimum, matching at least the debt that you have on the books getting started.
When you're young, you have this air of invincibility, like nothing could ever happen, right? And you don't have the perspective to see that things do happen. I was doing a loan for a client who the husband and the wife, they had 7 children, and they were, as you might suspect, moving up to a larger house.
Yeah.
And this gentleman was a linesman and was working on electrical lines. And he passed away through a job injury, touching an electrical line in the middle of the escrow, closing on their house to move their 7 kids up. And he had no life insurance. Well, he had a very small premium that he got through, the employer.
Mm-hmm.
But it wasn't enough to take care of all of their liabilities. It wasn't enough to put that family into a new home. And I think as I think about my younger years in my 20s and 30s, I certainly wouldn't have had the perspective to see that those kind of travesties can happen. And at a young age, it's so cheap. It's so inexpensive to give us just enough insurance to make sure that your spouse and your kids would be taken care of.
Yeah, it is. And life insurance and disability insurance are hard to decide on in your 20s or your 30s. But the reality of it is, usually when you're making a decision to purchase either, it should be as if you were standing in your shoes 5 years from now, because you don't want to buy something that will become irrelevant in the next 5 years. Otherwise, you're going to have to go back through the process all over again, and you're going to end up getting charged way more in the premiums that you're paying for the insurance contract that you actually need. And so initially, it may seem a little bit striking, the amounts of insurance that some people will recommend, but it will end up saving you a lot of headache and time and money in the long run.
Yeah, those premiums are infinitely cheaper in your early years than if you have an expiring premium 10 years later and you still need the premium. There's no doubt.
Yep.
Plus, it's a pain in the butt to go through the whole life insurance policies process of getting approved. So just do it once and have it cover you long enough until you think you won't need it anymore. That's exactly the way we thought about it.
Yep.
So what do you think the biggest mistake that highly educated millennials make when it comes to money management?
So I think we've alluded to this maybe a little bit leading up to this point, but the debt repayment versus investing is the biggest mistake that I see. And I would say 95% of the people that I talk to fall into this category of wanting to repay debt so much that they will put wealth accumulation on hold even longer. And when you're talking residents and fellows that are getting ready to graduate from training, we're now into our 30s to 35 year or age range. And so you've already delayed retirement 10 to 15 years compared to the average worker that starts fresh out of undergrad. And that can put you into the ballpark of saving twice as much as some of your peers had to have a very similar retirement. Even though you're making more money, it still hurts to put more money away.
Well, and if you look at long-term appreciation charts, and you consider that you're going to have a 6 or 7 or 8% return, the long-term appreciation and accumulation of those assets is far going to outweigh the amount of additional interest you're going to pay, especially in today's low interest rate environment. Mm-hmm. So what steps can people take to make sure that they avoid that mistake?
So the easiest answer would be to talk to somebody that can give you objective advice, because a lot of times yourself and even your friends and family members have emotional information to provide back to you on this topic. And what you need is somebody to be at least a couple steps removed from that situation specifically to provide you objective advice for your situation, to make sure that the numbers align with the advice that is being given. But again, consider long-term goals and what you want to do with the funds that you will be generating post-graduation. And then the interest rates that are on the table at the time. Right now, there is no interest being accumulated on student loans through at least the end of September. So for anybody that has excess cash right now, you could be putting additional money towards loans while interest rates are zero, or save that money maybe into a slightly higher interest rate savings account, keep it until the end of September. And if the plan is then to refinance come October, November, then put a large chunk of that excess cash into that student loan if you really still want to, or have accumulated more liquidity along the way and have the ability to put a chunk down before refinancing. And save yourself a little bit of money as opposed to paying it off at the highest of interest rates. Get rid of that principal a little bit quicker.
Yeah, I think that's really wise. And what I'm hearing from you is, you talked a little bit about, of course, everybody knows diversify the different asset classes that you're investing in. Mm-hmm. We also talked about just diversify where your financial plan is, not to put all your eggs in repayment of debt or all your eggs in investment, but to make sure we have life insurance, some money going towards paying down debt, some money going towards investment. We've got a liquidity fund. So that's kind of diversification of the whole financial strategy. And the last thing I heard you say was really diversify your advice. Make sure you're not just getting advice from one person that has a narrow focus or narrow perspective, but get advice from multiple people and then come to a diversified conclusion.
Yeah, and I think that is good advice for people in all different industries, because more often than not, what we do is we go to our mentors who are in our same occupation and get advice from them based on their experience, which tend to come from their mentors. And so then you end up with this pocket of people who have all received identical advice, even though we don't know where that advice originated and or if it was truly the objective viewpoint that was provided initially. And so it may not necessarily be the worst thing in the world, but it might not be the best for your situation specifically.
Yeah, really great point. Great point. One of the analysis we do for clients all the time is we'll show them, here's what it looks like if you pay down your mortgage over 15 years. And here's what it looks like if you repay that mortgage over 30 years. And then we take the delta between those two payments. Mm-hmm. And if you invested the difference in, let's say, some diversified investment pool that yielded a 6% return, what happens to your wealth over 15 to 30 years? And what's interesting is in almost all instances, you have accumulated enough wealth in this side investment pocket that you could actually pay the mortgage off sooner. So if you did a 30-year loan, even though you're paying a slightly higher interest rate, you take that extra cash flow, you invest it, just figuring it a 6% return, which is pretty conservative. That pool of money could actually pay off the mortgage balance faster than if you just did a 15-year mortgage. And it sounds like that's kind of the strategy or what you're trying to help people arrive at as well.
Yes. Yeah. The exact same scenario happens with both paying off homes and paying off student loans, or even, paying off cards or credit cards is a completely different ballgame. Obviously, those are something that we probably want to get rid of before we're talking anything else. But if you have low interest rates, we definitely want to invest the difference. Similarly to a lot of people will talk term life insurance versus permanent life insurance and say, buy term and invest the difference, because of the returns that you might be able to see from the excess money that you're putting into the market compared to what you might get on a certain type of a permanent life insurance contract. And so we want to, again, just do the most with that money that we're given, as opposed to doing the one thing with those funds.
That's an interesting perspective. I've never heard somebody talk about that. So you'll help clients think through doing a term, which will have a lower policy, and then using the excess cash flow to invest. That's a really interesting philosophy I don't think I've ever heard of before.
Yeah, so we get a lot of clients that you like term insurance because it is going to provide the most amount of insurance at the lowest cost possible.
Right.
Which essentially will give you the difference between a whole life insurance contract and a term life insurance contract. The difference in cost for the same amount of insurance is pretty dramatic. Mm-hmm. So we can compare those to investing the difference into any just regular brokerage account and what that might accumulate over the course of your working years, compared to purchasing just that one whole life policy. If you're talking different types of permanent life insurance with a little bit more flexibility, that might change a little bit, because the accumulation on some of those other permanent policies will grow a little bit better than what you'd see on the whole life side. But there's so many variables in the investing space and the insurance space for people to consider with their assets, that guaranteeing yourself the 3% payoff on your student loans after refinancing them might not be the quickest way for you to grow wealth.
Really good point. I love that. That was a thought I had not come up with before. And I'm glad you pointed that out. Again, it's just diversification. You're just not putting all the eggs in one basket, because you never know what crazy event's going to come at us.
Yep.
Yeah, really well said. All right, so let's talk about the myths in finance that you wish people knew the truth about. What do you think are the biggest misconceptions out there that you'd like to warn people or educate people around?
So I think all of my answers were very similar to the questions that we laid out, but the biggest myth would be that you have to be debt-free before you invest.
Yeah.
So I know there's a lot of financial planning podcasts or talk people out there that will say that you must be debt-free before you put money away, but really that's not the case, as we've alluded to leading up to this point.
I couldn't agree with you more. And I see some people make that same decision, that same thought process before they buy a home. We have to have 20% down, or we have to be outside of all these debts. And in the time that it takes them to save the money or to pay off those debts, you look at homes that have appreciated 20 or 30%. In retrospect, they would have been a heck of a lot better to put down a minimal down payment, spread their cash flow between the mortgage, paying down their debts, other investments. And in 3 or 4 years, when the home's appreciated, just look at refinancing and going to a lower interest rate, or a loan that doesn't have mortgage insurance or more favorable terms. You can once you're in the game and your assets are appreciating, you have infinitely more options than when you're outside the game and trying to keep up with inflation.
Yeah. I think another, I don't know if it would necessarily be a myth so much as just a conception that people have, is that budgeting is terrible and that nobody likes budgeting. But I think it's just the way that people try to force themselves to fit budgets that are unrealistic. meaning that people do the exact same thing to themselves when it comes to dieting or exercise. If you try to go, you don't go to the gym at all, but now you're trying to go to the gym 7 days a week and you're going to work out for 3 hours a day, that is just definitely unrealistic from the get-go based on what you had been doing leading up to this point. And so the easiest way to establish a budget is to look retroactively at what you have been spending up to this point, and starting by looking at maybe what holes exist. You know, do you have 13 different streaming services that you pay for and you actually only use Netflix and Hulu? Can we get rid of some of those? Or how much money do you spend on eating out versus eating in? Is eating in a possibility for you based on your time frame with school and everything else that's going on? But then using those dollar amounts to set then the parameters for your budget moving forward so that you maintain a steady level of lifestyle while income starts to grow. Because then as income starts to grow, any excess can then be used to fund the goals that you've established for yourself. And then it will happen very naturally to the point where your savings is finally starting to accumulate and you really didn't have to do anything to change what you're doing from a spending habits standpoint, which is where a lot of people run into issues, is changing the mindset surrounding their spending and their savings to actually make things happen.
That's a great point. Where we put a little bit of awareness and a little bit of attention, we can almost always tighten and create a little bit more excess. And then if you can just lock down and agree, hey, these are the expenses that we're going to allow ourselves to have, and going forward, as our wages continue to rise, all that additional money can go towards other investments, paying down debts. That's a great way to look at it. It doesn't feel quite as restrictive and controlling.
Yeah, we like to talk about the budget as a tool to actually give you more freedom within your spending habits. Because once you've established that free cash flow to put towards savings, goals, debt repayment, and other things that you know you want to happen, anything that's left over after that at the end of the month is yours to use for whatever you feel like it.
Yep.
And so that gives you the freedom to know that this is my money to go to Cabo with, or whatever it might be for that given time frame.
Being able to live life a little bit and not have guilt for it.
Yep, exactly. No guilt around spending is the best way to live life, and should lead to a lot less people getting divorced because of their finances.
Which in and of itself is a pretty good financial strategy.
Yeah.
So Michaela, I think you are at the point where you are looking to purchase a house. Is that correct?
Yep. So we have officially sold the house that we are in.
Congratulations.
And we are getting ready to buy. So we're going house hunting this upcoming weekend is the game plan for us.
And how are you feeling about that in this market? You know, a lot of people I talk to are really worried that they're in a bit of a financial top when it comes to housing and all the crazy demand. We've been in a massive supply demand imbalance over the last few years. And so some people are becoming so fearful of what's going on in the real estate market that they're making the decision to just potentially wait it out. So walk us through your decision, how you're grappling with those emotions and where you're landing.
So I got a little bit lucky when we bought. We were in a buyer's market. And so we got a really good price on a nice place, and we're selling it in the peak of the seller's market at this time. So our return on this investment was huge, which makes it a lot easier to take the money, go look at new places, and know that we're not going to have to worry about putting more money down than we have at this time. But I know a lot of people aren't in that situation. But I get this question a lot. And my field is that the market's just been going up and up and up. And with everything that's going on in the world, it seems economically like we're maybe starting to slow down just a little bit. Interest rates and everything are starting to change, jobless claims, what have you. Are we about to see a bit of a bubble or a recession that's coming our way? Do I really want to put all of my money into the market at this point? And the answer that I tend to give is there is almost always a reason, daily, monthly, quarterly, annually, that you would not choose to put your money in an investment strategy. And if you use those fear tactics to stop yourself from making an investment, you're never going to pull the trigger. So not saying that buying a house at this time is the right fit for everybody, but if you have the flexibility financially to hold on to those investments for an extended period of time, the markets tend to go back up again and again and again and again. We've never seen a downward market for more than a couple of years at a time. And so with the knowledge that there may be a bit of a bubble, just don't freak out and write it out over the following years, and then reevaluate and see what makes sense financially at that point. Maybe you hang on to the house, make it a rental, move into the next place. It's more of a lateral move as opposed to a vertical move, and then reassess what finances look like at that time, because things are constantly changing. And that is why you always need somebody to provide you some objective financial advice, as things tend to vary quite often.
Yeah, great point. Really sage advice. And some of the best advice that I've ever received, and I continue to look back over my investing career, and it's the longer this plays out, the more almost 100% truth it is. And that investment advice that I got very young, I got this from a mentor of mine, which I'm sure read it in some great book. But he told me, it's not timing the market, it's time in the market.
Yep.
And as I look back, I bought my first investment property with my mom. We partnered on an investment condo this would have been 22 years ago. And it was a little condo that we purchased, and we bought it to fix it up and to resell. And by time we bought it up to fix it and resell, we had a little market blip, and the value of the condo had gone down by about $15,000.
Yeah.
And we'd put $10,000 into the property. So we quickly found ourselves underwater by about 25%. Right. We ended up taking long-term financing in it. We put a renter in it. We still own that property today. And that $85,000 condo is now worth well north of $300,000 23 years later or 22 years later. And that was just one of those instances. In that moment, I felt like I couldn't have timed the market any worse. But it's paid cash flow, and we've had a great cash flow from it for years, and now has appreciated by almost 300% over that period of time. So it wasn't the timing of the market, which you never know if you're going to get right, or you never know if you're going to get wrong. You're just, you're lucky, right? But it's the time in the market that makes all the difference, I think, for long-term wealth.
Yeah, absolutely. I think Warren Buffett says, if you cannot part ways with your money for 11 years for whichever investment strategy you're focusing on, then you shouldn't do it. So everybody needs to think about this as a long-term play, whether it's real estate, whether it's investing just in individual stocks, bonds, what have you. It needs to be something that you do not need that liquidity for in the foreseeable future.
Yeah, great point. Which goes back to the previous comments around don't put all your eggs in one basket. If you have to put every penny of your liquidity into buying a house, might not be the right time.
Right.
Maybe you need to look at options with a little bit lower down payment, so you'll have some staying power if something goes wrong.
Yep, exactly.
I wanted to touch just one more thing go back to your house that you own now and you're going to be selling, and then I'll move on to the final question. Do you mind if I ask a personal question of how much money you put down when you purchased your home?
So we financed with an FHA loan. Awesome. Initially, because I was coming out of undergrad and my husband was as well, and then transitioning into medical school. So my income, new professional, just getting started, we had next to nothing down. We worked with a great lender to make the numbers work for us. And so I think maybe a couple $1,000s we put down on this house, and we're netting about $60,000 on the sale of it over the course of a 4-year period.
You know what I think most people, and the point I was trying to get out here, I think most people don't understand when they see something as amazing as nationwide appreciation last year at 7.76%, where I live in Utah, we were just over 10% appreciation last year. But what's amazing about real estate is the leverage that the debt provides. So let's just say that somebody in 2019 bought a $400,000 house and they put 5% down. So they put $20,000 down. And then in 2020, we had a 10% appreciation rate. Well, that's not 10% on the $20,000 you put down, which would be $2,000, right? It's 10% on the full asset on the 400,000. So that means the $400,000 home is now worth 440,000. And that's a 200% rate of return in 1 year, right?
It's a great way to look at it.
Yeah, you're doubling that initial 20%, $20,000 down, which was 5% in 1 year, which is absolutely amazing. And there's virtually no other asset class that I can think of that enables you to get into the game and have the leverage as does real estate.
And I think it's really good to look at it from an institutional view as well, because if you go look at the financial ratings of really large companies across the United States, they're actually dinged for not having enough debt on the books. So if an insurance company, for example, has too much liquidity and not enough debt to that liquidity, they are docked in terms of their financial rating across the board. And I think individual investors need to take that mindset just a little bit more to heart, because a lot of people want no debt. And really, debt is created to give you more leverage to do more things with the money that you have. It should not be viewed as a bad thing that must be removed in all circumstances.
So I was recently reading an article about Apple, and they took out a record amount of debt last year in, I believe it was 2020. And it was something in the neighborhood of 7 billion that they borrowed, and they had in cash on their balance sheet, like 70 or 80 billion. And so the question would be, why is a company with 70 billion in cash borrowing record amounts of debt? And what Apple knows, and the financial advisors that are helping them with their strategy, is they know if I can take out a 2 or 3% loan and stretch that bond over 20 or 30 years, and then I can make a 6 or a 7 or an 8% delta, the difference between what my yield is on that debt and what my cost is on my debt, why wouldn't I take out as much of that debt as possible that I can manage that upside and continue to get a great return? But individual investors don't seem to understand the strategy that has made major corporations in Wall Street so wealthy.
Yeah. And the low interest rate environment, I think, is making that more and more apparent, because the wealthy, in times where interest rates are really low, and everybody's liquidity is really low, are making financial decisions that are dramatically increasing their wealth compared to the rest of the population. Whereas people with no liquidity or no flexibility right now don't have the ability to take advantage of the low interest rate environment that has been upon us because of the pandemic.
And back to your point, if you don't have any debt, you were talking about, your example was an insurance company or a public company that doesn't have any debt. But the same thing holds true for individuals. We've had clients who don't have any debt and therefore have no credit score.
Yep.
And then they go out to try to get a business loan or an investment property loan or a primary residence loan. And all of a sudden, with no credit score or with very few trade lines, it makes it harder to qualify. So having yourself a credit score and having credit history can be an asset when you're trying to leverage up to buy an investment property or another primary residence.
So what do you typically recommend for somebody that is getting started out to build credit?
Really great question. Thanks for asking that. The most ideal structure would be to have at least 5 lines of credit and open for at least 12 months. And don't mistake that advice for go leverage up 5 credit cards.
Yeah.
That is not what I'm saying. But you should have 5 lines of credit open that you go put a tank of gas on, and then you pay off that tank of gas, or you go pay for a dinner, or you pay for a trip and then you pay it off. It doesn't have to have consistent balances at all times. It just needs to have some activity. So if you want to really have the most factors working for you to increase your credit score, it's 5 lines open for at least 12 months. And the longer they're open, the better. So another mistake that I see people make is they have lines of credit that have been open for years. They pay them off. And then like in some sort of victory celebration, they close those lines. The victory is the zero balance. Don't close those lines. You want those open for as long as humanly possible. The reason why older people tend to have higher credit scores is because they've got a 20-year American Express card that they may or may not use, but it's reporting as paid as agreed for 20 years. And that is what's going to get you the ultimate credit score. So leave those open as long as you can. There's absolutely nothing wrong with having 7 or 8 or 10 lines of credit, as long as your balances are low or zero and they have minimal activity. Those are going to continue to rate and they're going to amplify your credit score.
And is there any right amount of, credit limit to used credit on that card or line of credit that you typically recommend? Great
question. So once you start to get balances greater than 30 to 40% of the limit, so let's say you've got $1,000 limit, once your balance exceeds $300 to $400, it's going to start to show a higher utilization, and that'll push down that credit score. So ideally, in a perfect world, you would want to try to keep those as low as possible, especially if you're going for a home loan sometime in the near future, or you're going to finance a car in the near future. So some activity is required, but if possible, keep it below 40%. And I tell some clients that are going through the process, hey, if you're in the process of house hunting and you have major expenses with movers or relocation, things you normally put on a credit card, just make a bi-monthly payment. So every 2 weeks, just pay that credit card balance down. So at any time, if you have your credit checked because you're buying a house, your credit score is going to be as optimized as possible.
And I know some credit companies will count dual monthly payments twice toward your credit score. So if you're trying to build credit just a little bit quicker, you can almost double up on the reporting on that specific card. Like I think Citi is one of those companies that will allow you to set it up to pay it off twice a month, and then they will also report it both times.
Yes. And with some of the credit changes that have come into effect in the last couple of years, they're not only judging if you're making your minimum payments, but the frequency that you're making additional principal payments. So the more you show a willingness to make on-time payments and pay off principal balances, the higher the credit score rating is going to be as well.
Nice.
Michaela, this has been a blast. I want to end with one final question, and then we'll get your contact information so people can reach out to you. But I always like to know, what is your personal favorite financial-based book that you've ever read, and what would you suggest our listeners read?
Yeah, so I have The Millionaire Next Door is the book that I went with, and just because it makes finances so simple. It is truly all about, living below your means, and the fact that being wealthy doesn't just mean earning a high income. It's what you're able to do with those funds that you're receiving. And that everybody, again, just overlooks the basics, the financial foundation of budgeting and planning and keeping it simple. And so I thought that was a really good plan for this podcast too, just because it is right in alignment with all of the things that we've covered today.
It is definitely right in alignment. And that book makes it so abundantly clear to know, just save a little bit, make sure that you invest for the long term, and everything's going to be okay. It doesn't have to be too much more complicated than that.
Yep, exactly. People are scared of finances because it seems like it's something that's complicated because they don't have time to get their MBA or go to school or learn about it outside of their profession. But really, it should not be something that is overly difficult. It just takes just a little bit of thought and consistency.
Totally agree. Well, it's been a blast having you with us today. Really appreciate your time and how generously you've shared with our listeners. Where can our listeners find you if they have more questions or want to connect?
Yeah, so my direct phone number is 402-915-0113, and I do get texts and phone calls to that number. And then my email address is just my first name, Michaela, Michaeala @physiciansthrive.com. And then I do also have an Instagram that is just my first name, Michaela_Speer, which is my last name. And then my calendar link, which is spearmichaela.youcanbook.me. So there should be a lot of different ways for people to find me, but I'm pretty sure if you Google it, you'll find our website, which is pretty easy to navigate.
Thank you so much. We'll make sure we have all your contact information in the show notes as well. So we'll include all of those. Good luck to you and your husband to your move to Ohio. Happy house hunting. And if there's anything else we can be doing for you, don't hesitate to reach out. It was a blast connecting with you today.
Yeah, absolutely. Thanks for having me, Josh. This was fun.
Thanks for listening to the Infinite Financial Freedom Podcast. Subscribe to us on Apple Podcast and Spotify to be notified of all future episodes, and follow us on social media to join in on the conversation. If you'd like to learn more about Neo Home Loans and how we empower homebuyers with financial literacy and guide you on your journey to financial freedom, visit neohomeloans.com.